but thank you very much for joining. We really appreciate it. So this is the Tax Smart Real Estate Investors Facebook group live Q&A, the first one that we've done. Really excited to interact with you and answer some questions here live. It's just going to be an open forum. So any question that you want to ask, we can talk about it. I might ask you additional questions. Would really appreciate, since I will probably put this on YouTube, if you can come off mute and ask your question, that will be great. If you don't feel comfortable doing that, that's fine. You can just throw it in the chat. I'll read it out loud and then I will answer it for you. So with that said, let's take our first question. Who's got one?
I do. This is Karan Narang.
Yes.
There's a lot of confusion around STRs and material participation. Everyone's got a different definition of it. My definition from reading your website, actually, I've seen your definition a few times, on making sure you can categorize STR losses as non-passive and material participation with it. To me, it's pretty clear, but I'd love for you to reiterate what needs to be done. My interpretation is, as long as I am self-managing the property and managing that, and to me, self-managing means taking the bookings, interacting with all the customers, and handling or coordinating the cleaning and the maintenance of the property, that is material participation, I would probably meet the over 500 hours versus the over 100 hours required.
Okay. Do you have a property manager on the short-term rental?
No property managers. I just have a cleaning crew and a maintenance crew.
So when you don't have property managers on your short-term rentals, it's going to swing more in your favor. It just becomes more believable that you're actually doing all of those things. If you told me that you had a property manager, I would kind of say, well, I don't know if the coordinating with tenants and all that stuff, if that's actually going to rise to the level of material participation. So what you have to look at is, am I doing things? First off, am I involved on a continuous, regular and substantial basis? So that's one, right? And if you are self-managing, you probably are involved on a continuous, regular, and substantial basis. If you are coordinating with the tenants, you're the one that's posting everything on Airbnb and Vrbo. You're the one that's coordinating with the contractors. You're structuring the leases, collecting the rents, collecting the security deposits. Then those hours are managing the property. That would definitely be material participation level of hours. And at that point, the interesting thing with that would be, are you involved on a day-to-day basis, or is it? Talk to me about that.
Absolutely. So what we have, for example, is I've got 2 cabins, and I set up the reservation and booking system through a system called OwnerRes. It connects with Vrbo and Airbnb. I'm managing the listings. I'm updating the rates. I'm taking the bookings, answering queries, giving them instructions on how to access the cabin, what to do, and everything. So there's nobody else dealing with the guest other than me on a regular basis. And my cleaners, my maintenance, nobody deals with the guests but me.
Okay. So the cool thing, so investor level hours are reviewing financial statements, doing the bookkeeping, paying bills, preparing your tax return. Those hours don't count towards material participation unless you are involved in the day-to-day management of the activity.
Yep.
So if you're self-managing and you can show that you're also involved on a day-to-day basis, those types of hours will also count towards material participation. So you kind of expand your scope a little bit of what's going to count towards material participation. So I think when we have people in your case that are self-managing a rental, and the only other participation in that rental by any third party is going to be a cleaning crew, it's going to be somebody like contractors coming in to do repairs and maintenance and that type of thing. Then we would feel relatively comfortable. I mean, granted, everybody's situation is different, so caveat, but we would feel relatively comfortable. Or you would have a much better shot at substantiating your hours as material participation hours. The issues come when somebody's got a property manager and the property manager is doing all that work. Now you've got to try to restructure the property management agreement. Well, property manager, you just do these things and I'm going to do these things that you would normally do, but this is how I'm going to hit the material participation hours. And you got to do enough of that to basically outpace the property manager. And that gets really hard to do.
And is it also fair to say, just like we for non-STRs, for regular real estate, you're able to group properties together to achieve the material participation. Can you also do that here for STRs if I've got 2 and say total? It is going to cross over 500 hours anyways, but just wanted to see if it's easier to achieve if I can group it for STR and do that.
Yeah, so under Treasury Regs 1469-4, there is an election to group like kind, I forget the exact terminology, but if they are similar businesses, then yes, you can group them. So you can group short-term rentals with short-term rentals. At least that's our position.
Okay, no, that's fair. And one last question before I, hand off to anybody else. Unlike reps, so reps, this has to be, it has to be the primary, I'll call it occupation, correct? 750 hours plus it has to be your main, I'll call it source of income or primary occupation. Unlike that, for me to set off this against other W-2 income, I can have a full-time job, 20, 80 hours a year, and I could still, as long as I prove that I'm materially participating with 500 hours or more on this activity, I can consider it non-passive and write off against W-2 income, correct?
Yes. And
Okay,
and let me talk about that just for everybody else in the room and anybody that might watch this later. So is it Quran?
Yes.
Okay, cool. Nailed it.
Thank you. That most people think I'm Karen and say, can we speak with your wife?
I know. Well, I didn't want to say that because I was like, I don't know that that's going to fly. So Quran is asking, basically what Quran's asking is he's got a good understanding of how the passive activity loss rules work. So the passive activity loss rules say all rental activities are passive unless you qualify as a real estate professional. And that's what he was saying as a rep, right? And we'll use reps for real estate professional status, so REPS. All rentals are passive unless you qualify as a real estate professional for tax purposes. To qualify as a real estate professional, you have to log 750 hours in real property trades or businesses, and you have to spend more time in real property trades or businesses than you do anywhere else. So if you have a full-time job, 2,080 hours, you've got to spend an additional 2,081 hours in real estate. That's a lot of time. Tax court's not going to buy it, so you're going to lose most. Actually, I'm not aware of a tax court case where somebody working a full-time job has ever won. So part-time job people, if you have a part-time job, then you can certainly do it, right? I have 1,000 hours in my part-time job. I spend 1,001 hours in real estate. Cool. I meet that second test. But to qualify as a real estate professional, 750 hours in real property trades or businesses and more time in real property trades or businesses than anywhere else. But if we kind of back up, what we said was the passive activity rules stipulate all rental activities are passive unless you qualify as a real estate professional. Well, under Treasury Reg section 1469-1 cap T, there's an exception to that rule. And one of the exceptions, there's multiple exceptions. I think there's 7 exceptions, but one of the exceptions says, if your use of tangible property, if tangible property is used, rented out on an average of 7 days or less per customer, then it's not a rental activity under section 469 of the code. So section 469 again says all rental activities are passive unless you qualify as a real estate professional. But then this carve out, this exception says if you have a rental property that's rented 7 days or less on average, then it's not a rental activity. So what that means is for short-term rentals, as long as my average rental period is 7 days or less, I don't have to worry about real estate professional status because I don't have a rental activity. So then the next thing that I have to worry about under the passive activity loss rules is, did I materially participate in the business or not? Because you always have to materially participate. Even if I am a real estate professional, all it does is just gets rid of that. All rentals are by default passive unless you qualify as a rep. So it just kind of pushes that aside, even if I am a real estate professional. But then the second hurdle is always, did I materially participate in the activity or not? So you still have to figure out how to materially participate in the short-term rental, but you don't have to worry about real estate professional status. So what that means is I can buy a beach home and I can manage it myself. I can spend 100 hours and more than anyone else managing that property myself. And I'll track it to make sure that it all happens. I'll educate myself on the hours that count and don't count for material participation purposes. We have a a huge guide on this. It's like a 12,000 word guide, www.therealestatecpa.com. Click on the education tab, you'll find it. You can download it. We talk about what counts, what doesn't count with tax court cases as citations. So you know that we're not full of junk. But I have a short-term rental. I don't have to worry about real estate professional status. I still have to worry about material participation. But if I hit 100 hours of material participation and nobody else spends more time than me, then I'm materially participating in that activity. It's no longer passive. It's now non-passive. That's the only thing I have to worry about with short-term rentals is material participation. So I can have a full-time job. Karan, to answer your question in a very long-winded manner, I can have a full-time job. I can buy short-term rentals as long as the rental period is 7 days or less, and I materially participate, then it's a non-passive activity. Now I can bonus depreciate. I can run a cost seg study. I can bonus depreciate it and take the tax losses against my W-2 income.
Perfect. Thank you.
No problem.
May I jump in?
Yes, Lana.
Thank you. Okay, I have several small questions around the same present issue of bonus depreciation and passive losses.
Okay.
So being an LP in multiple syndications, I've accumulated substantial pool of passive losses suspended. Okay. Question number one, if I enter into a TIC, tenants in common right now, for a multifamily property, and we'll do cost segregation, elect bonus depreciation, right? So I'll have substantial losses from my TIC at this point. Ultimate question is, would those losses be combined in the same pool as my passive losses from my multifamily syndications?
Yes. So the way that this all boils out is passive losses are passive losses, and that's it. You can be passively invested in a business where you don't materially participate, you don't have voting rights, you don't make management decisions, you're not part of the day-to-day. Passive activity. If it creates a loss, it goes into the passive bucket. So think about it as buckets. You got a passive bucket, you have a non-passive bucket.
Okay, so I just want to confirm. That's what I thought. Just want to confirm. The reason I'm asking, and this is more, no one talks about it. So tell me if I'm completely off and wrong.
Okay.
But to me, it looks like everyone is jumping with joy and happy that they're not paying taxes today. It's going to go on for a few more years. But at some point in the future, to me, it looks like, unless I'm wrong, looks like this bonus depreciation tsunami is coming. It's going to be so bad. And again, my train of thought, okay, right now it's great. I'm talking about passive investors, okay?
Yes.
So have all these huge pools of losses accumulated. So as our bonus depreciation gradually phases out over the next several years. So it's not, the party is going to stop at some point, okay? So for the next few years, as we sell those syndications, and we have profits, hopefully nice profits, we're not paying taxes because those profits are offset from the pool rate of suspended losses.
Correct.
So it goes on and on. At some point, that pool starts to dwindle down just because it's going to be eaten up by the gains, right? So it goes down and down and down up until the point when it's equal zero. And then every next property sold would have a huge tax implication, because now we have to pay taxes for the actual profit, for the recapture depreciation that we don't have to claim. So it's like it's all exposed, and God knows what else. So at that point, it's like, it's bad.
Yeah.
Okay, so am I correct thinking that that's, unless nothing is done, or unless anything is done, this is the way it's going to look, right? Okay, 100%. So my next question, the reason
well, let me talk about that real quick. Okay. So what Lana's hitting on here is, if I bonus depreciate property today and I get the big big passive losses that become suspended because I can't use them. I'm not a real estate professional. It's not a short-term rental. I'm not materially participating. So it's just passive. What I'm doing is I'm just accumulating suspended passive losses. And that's not a bad thing. At some later point, that can save me from having to go through the rigmarole of a 1031 exchange. Not to say that 1031 exchanges are bad. It's just a process. There's a lot of admin stuff that you have to do during a 1031 exchange. So I don't have to worry about that. I can just sell the properties outright until my pool of suspended passive losses reaches zero. It doesn't mean that I would still sell the properties outright. It doesn't mean that there's not other exit strategies available to me. And we also have to think that that could be 7 to 10 years from now. Who knows what the tax code is going to look like at that point? Do you know how much the tax code has changed in the last 2 years? More than it's changed in like 2 decades. It's incredible. Well, that's probably not true, but there's a lot of tax changes in the last 2 years as compared to previous years. So we don't know what it's going to look like 7, 8, 9, 10 years from now when you might be liquidating these deals. So what can you do? Well, you can do a 1031 exchange if you have any control. If you're investing in syndications, you don't have control. You can't do a 1031 exchange. They have to do the 1031 exchange. You can't 1031 exchange partnership interests. So what can you do? Well, you might have the option to drop out of the partnership. And as a result of dropping out of the partnership, you get a tick stake in the same property, and then you can 1031 exchange out. Some syndicates and funds are more flexible with that than others. But if you've got something coming up, if you've got a liquidation coming up in the next 2 years, maybe you start having that conversation. So that's one option. Another option is to buy more property. So this syndication, I'm out of my suspended passive losses. 2 syndications liquidate this year. It's like a $600K total gain with depreciation, recapture, and cap gain. It's going to crush me tax-wise. There's nothing stopping me from buying more property and cost segregating that to create losses. I can buy triple net lease properties. It doesn't have to be something I even have to actively manage. Triple net lease, commercial, multifamily, anything that would, or even mobile home parks, anything that would give me a lot of benefit from a cost segregation study. That's an option as well. If you're exiting real estate, this is where it becomes problematic. If you're exiting real estate and your holdings are primarily made up of syndicates, that is where it becomes problematic. And what you're explaining is linear at that point. And what I mean by that is I have suspended passive losses. Once they reach 0, I'm toast. If you don't want to keep moving that money into real estate, then that's what will happen. You will have a large tax bill at that point. And you're right, not a lot of people talk about it because they want to talk about all the bonus depreciation that you get today. And what we try to explain to people on any presentation that I'll do is that it's an arbitrage strategy. That's all it is. And it's good because it's time value of money, right? And you can argue, well, I can't take my suspended passive, I can't take my losses, they just become suspended. Yeah, I agree. So not very effective for you. But you never know what type of opportunity that gives you, right? Maybe in a month, one deal reaches peak, or they get $1 million extra offer than the best offer that ever they liquidate. Well, now you're not complaining because you've got all the suspended losses to offset that. So you're good. But at some point, you got to pay the bill. At some point, you got to pay the bill because it is an arbitrage strategy. I take the depreciation today. I get the tax benefit today. Some later point, got to pay it back.
Sounds like you kind of answered, because the conclusion of my ultimate question was, you kind of addressed that, I think.
Yeah.
I'm thinking my strategy now, because I'm in real estate for the rest of my life, but I'm thinking my strategy now would be, instead of focusing on syndications as an LP, now switch my focus to maybe trying to get into a TIC with large amount of money while we still have 100% this year and next year.
Yeah.
Since it's the same pool, and then offset that from the TIC.
We see people, and yes, you can do that. You can get into a TIC, they can bonus depreciate. It's on your Schedule E now. You can always 1031 out of the TIC. You can 1031
that's the idea.
TIC. Yeah.
Mm-hmm.
We see a lot of people like start their real estate portfolios by getting involved with syndicates, and then they meet people, they network. And I mean, think about like over a decade. If you spent 30 minutes a day for a decade trying to meet people in real estate, the opportunities that you will have 10 years from now, it's incredible. It's incredible. Like, people are just so entrepreneurial. They want to connect in real estate. If you spend 30 minutes a day just sitting on LinkedIn talking about, you're just connecting with people, you will have so many opportunities coming out of these syndications. As long as you want to keep being in real estate, I'm not that concerned about your tax bill.
That's great. I love that. It's a great conclusion. I have completely unrelated questions, but I'll let someone else, and then I'll jump on.
Well, Ryan came off mute. You want to go, Ryan?
Hey, Brandon. I know we've been back and forth for like over a year now, I feel like.
Yeah, man. Thanks for joining.
Communicating. Yeah, it's been great. So yeah, I'm a CPA here in Chicago and looking to invest in properties of my own. I think the first question I had is because I've listened to your real estate like pro podcast multiple times, even like the older ones that you guys used to do. I've read the guide. The in the last podcast, you mentioned a link to like a workbook to track real estate professional hours. And Thomas had mentioned that it would be in the show notes, but I didn't see a link. And I checked on your website as well as the podcast. I didn't see it anywhere. I was just wondering.
Yeah. You caught us. You caught us red-handed. No, yeah, I guess we just forgot to throw the link in the show notes. So thank you. I will have Tom do that, and we will have that updated later today.
I think one of the questions too, I guess, so not about the test for the real estate professional status, but just the regular material participation test under 469. One of the easiest ones to meet is at least 100 hours and more hours than anybody else, or like, you need to have 100 hours and more hours than anyone else. The problem that I see with that is, let's say you do have a property manager, which you may still be able to reach 100 hours. Do you go to that property manager and say, I guess, is it one individual, or would it be the property management company as a whole? Because the regs say more than one individual, right? So like, would you have to go to that property management company and say, I need the hours out of each employee who serviced my property? I mean, I feel like that could get pretty dicey.
Yeah. So to answer your latter question, do I go to the property manager and ask for their time? The answer is yes.
Yeah.
If you read the tax court cases on anything like Lucero versus Commissioner, that dropped September 2020. That's a good one to go read, because Lucero, he booked like 260 some hours, and the tax court was basically like, well, you didn't provide any sort of proof to substantiate how much time your property manager spent, so we don't know if they spent more time than you or not. I don't know if this is necessarily correct, but my gauge, or my thought after reading all of these tax court cases, is that the IRS uses the 100 hours and more than anyone else as a blocker for you. The and more than anyone else is the blocker. If you're unable to show how much time anyone else spent,
right,
how can you possibly prove that you spent more than them? Right. So we actually have our clients reach out to the property managers on a monthly basis and ask, how much time did you spend on my property this month? How much time did you spend on my cleaners too? With short-term rentals, there's I forget the technology, but there's some like smart lock technology. We've talked about it in the Facebook groups, the Tax Smart Real Estate Investor Facebook group. There's a smart lock technology out there that you can install on your doors, and you can give your cleaners specific codes, and it'll track their in and out time, and it'll like run in an Excel sheet for you. So it'll just log it all. You can do something like that. That's awesome. But for property managers on long-term rentals, or just in general, you have to ask them how much time they're spending. We have about a 50% batting average on that. I mean, property managers, they're like, why the heck are you asking me about, that's
well, even with like, even with like independent contractors, right? I mean, somebody gives you a bill, they don't really say how long it took them. They just tell you what the price is, how much the parts cost, and that's about it. I mean, it's really like, that's what I tell like, a couple of clients is like, hey, I in order to claim this, they're in the mom and pop exception where they don't have to be a real estate pro in order to take advantage of the passive activity in order to offset potential W-2 income. But it's like, hey, you got to prove, you don't have to prove it to me. You don't have to prove it to the IRS. You got to prove it to a tax court judge who's been practicing tax law for 30 years, right? And those guys are really, here's the law, like,
Yep. And Karan just threw in the chat the brand of that smart lock link. It's I'm going to say this wrong. Schloss Encode. Yeah. Right. But yeah, no, you're totally right. And that's what clients like, clients will come to us and they'll be mad when we tell them, sorry, those hours don't count as material participation. And, CPA to CPA, there's a villain in every single story in the history of mankind. Every story, every movie, every book that you read, there's always a villain. Yeah. So I've tried to teach my team, hey, we don't want to be the villain in the client's story, right? Like we're the hero. We're trying to help them beat the villain. The villain's the IRS. We want to help them win. And when you structure your conversations that way, they're much more receptive, because at the end of the day, we want clients to be receptive to what we're saying, so that they don't get caught holding the bag or with their pants down when the tide goes out. It's definitely not gonna be a good look for them.
You said that like a ton of your podcast, and I started saying that those terms that you use.
Yeah.
Like I just like the one Real Estate Pro podcast where you talked about all the court cases, like Miller, Lucero, just really interesting. And you're totally right. I mean, it seems like every single year that goes by, and I go to taxcourt.us.gov every day, and just the amount of Real Estate Pro cases. I mean, Section 469 has to be, if not the most litigated part of the revenue code, and it doesn't seem like anybody's ever going to get it right. I mean, it just people end up in court every single year for real estate professional status.
Yeah. I mean, and the reason for that, if you haven't listened to the real estate professional status episode, we changed our podcast up. So the Real Estate CPA podcast, we're like 145 episodes in. We've been doing it for 3 years. And Tom and I sat down and we said, we've enjoyed interviewing a bunch of real estate investors and asking them what tax strategies they're using. But let's create series where we're going to dive deep into various pieces of the code. The first one we were doing is a really popular one. It's real estate professional status. So it's a 4-week series, about 30 minutes to 60 minutes per episode, where we dive deep. That's what Ryan's talking about. It's on YouTube, but you can also just check it out on Apple, like SoundCloud, Apple Podcast, the Real Estate CPA podcast. You'll find it there. But yeah, it's just Section 469, the passive activity loss rules, were implemented in 1986. Before 1986, I could be a physician earning $1 million.
It was free reign.
Yeah. I could invest in real estate. I could use the depreciation to offset my income. No ifs, ands, or buts about it. Income is income. There's no passive activity loss rules. Awesome. 1986 comes around. They add the passive activity loss rules. 1994 comes around. A bunch of real estate people are up in arms because they can't use their rental losses. So they add the real estate professional status. But real estate professional status is really for people that are in real estate in a significant manner. It's not for somebody that, I've got a W-2 job, my spouse stays home with the kids, and I went and bought 2 properties out of state. That person's going to end up in court. And hopefully they have a really good time log, which full circle brings us back to, what you were talking about. So yeah, we have our clients follow up with property managers. We have our clients try to lay out the expectations up front, though. Like, I'm going to follow up with you on an ongoing basis to understand how much time you spent in the property. And the reason for that is for tax purposes. I trust you to manage it. I'm not micromanaging you. I do not, you're the pro. I believe that you're going to do a great job. I have to keep track of your hours for tax purposes. My CPA is making me do it, right? We get to be the bad guy in the client story at that point. So that's what we tell our clients. Now, again, 50-50 batting average. Actually, that's probably even a little generous. But that's what you need for the 100 hours and more than anyone else, because how else can you prove more than anyone else?
It's hard. You can't. You really can't, right? I mean, like you said, that's like the gatekeeper that's the first rule that they're going to look at, right? And the real estate professional status rules just exist to keep your doctor or lawyer buddy from, offsetting his W-2 income with passive losses, right?
Yep, exactly. Yeah, it's there to stop the tax shelter. A lot of people are taught that real estate professional status is the loophole. And I mentioned this in the podcast. I mentioned it on the presentations that I do, but real estate professional status is not the loophole. Short-term rentals, that's a loophole. That's like a regulation that excludes rentals from being a rental activity. That's a loophole. But real estate professional status, that's not a loophole. It's part of it's part of the code and the regulations that were implemented to stop the loophole. The loophole was I could invest in rentals and use the depreciation to offset my income. That got closed. Andrew had a question here in chat, and then Saurabh, I'll get to you next. So Andrew, you said, do you know if the 1031 exchanges are definitely going away for individuals with income over 400K? If so, are DSTs still going to be an alternative to circumvent this? Great question. So Andrew, I believe that you're referencing the upcoming Biden tax changes. My understanding is that within the next couple of weeks, we should have a lot more clarity on that. Today, I don't know. But as soon as I know, I will let everybody know in that Facebook group. We'll have another live Q&A about it or a webinar about it, and we'll go through it. Yep. So Rob?
Hey, Brandon.
Hey.
Yeah, thanks for taking the question. So I think I posted in the group also. I had the same thing, So, doing a partnership on a short-term rental, right? And if it's not your spouse, it's like, between two friends or like two partners as such, there is that LLC structure you mentioned, which sounds really good. But my main concern is like, how do you split the tax benefits? Because the participation rule is like that 100-hour test, right? But you have to do more than anybody else.
Mhm.
So how would both the partners qualify for that?
So there is there's 7 tests for material participation. What you just cited is one of the 7. There is another test that says if it's a significant participation activity and you spend 100 hours in the activity and you spent 500 hours in all significant participation activities, and the only reason that you're not materially participating is because you're not meeting one of those other tests, then you do materially participate. So partners can still materially participate, but what you're talking about right there, it's a great foresight. You need to plan around it, because if you and I are partners and I know that you're going to spend 110 hours, well, I want to make my life easy, so I'll spend 111, and then I'm going to be materially participating, but you're not under that 100 hours or more than anyone else rule. But you do have a fallback, and that's that significant participation activity rule. So let me try to lay it out like this. If I had 3 rentals, 3 short-term rentals, and I didn't group them, so they're all 3 separate activities.
Right.
Let's say I spend 100 hours in each one of those 3. Let's say that I spend 250 hours in one of them, and then the other 2, I spend at least 100 hours. But when I look at all 3 rentals, I've spent at least 500 hours. Okay.
Right.
Let's say that all of these rentals are significant participation activities. So for whatever reason, even though I spent 250 hours in that first short-term rental, maybe it's a partnership. Maybe my partner spent 251 hours. So if that's the case, I can't meet 100 hours more than anyone else because my partner spent more time than me.
Right.
I can't meet the significantly all. My participation is significantly all of the participation because my partner spent half the time too. So that one's out. And I didn't spend 500 hours in the activity, so that one's out too. So I would be not materially participating in that activity, but it would be considered a significant participation activity. A significant participation activity is one where you spend at least 100 hours and you're not materially participating in it based on the other rules. So that would meet that test. I spent 250 hours. I can't meet the other material participation test because I got a partner who spent 251 hours. So it is a significant participation activity. If you spend 500 hours in all significant participation activities, you will be materially participating in your significant participation activities. So let's say the other 2 rentals, let's say I spent 125 hours each in the other 2 rentals. And let's say I own 100% of them. I don't have partners. Right. But my cleaning crew spent 130 hours in each one of them. Right. Well, same problem. I didn't spend more than anyone else, but I did spend 100 hours. So I can't hit that material participation test, 100 hours more than anyone else. My participation is not significantly all, and I didn't spend 500 hours. But I did spend at least 100 hours in each one of those activities. So now they are a significant participation activity. And if I spent 250 in rental A, 125 in rental B, 125 in rental C, collectively, I've spent 500 hours. I'm materially participating. So you can still do it, just take some upfront planning.
So basically one person is doing 100-hour test with maximum, and the other has to do 500 then, right? 500 hours in a way, or?
Across their other significant participation activities. Yeah, not in that one.
Okay. So actually, I have like Jyoti, she's on the call, and we're planning to do a short-term rental together. I have one other one, and this is her first one. So we're just trying to figure out if it's doable to split the taxes. But this would be my second one, so it's with 2 short-term rentals, right? And this would be her first one. So I don't know if that would be, do you think it's still possible or can be, have you had clients who've done like partnerships and they do on short-term rentals and they're, equally or, able to divide the benefits, figure out ways of doing it?
Yeah. As long as you plan up front, then you're good to go. Where we have a lot of issues with partnerships is they'll come to us in December and they'll say, I'm ready to start like tax preparation. And then we'll look at their situation and say, cool, well, who's materially participating here? And they go, oh, we both are. And we start looking at the rules and we find, well, one of the partners actually isn't. So as long as you are having these conversations up front, like a good way to do this would be to loop our team in and say, we're going to go buy this beach home or this cabin home or whatever. Here's what we're thinking. What do you see material participation wise? Like, we want to make sure that we're both materially participating. What do we need to be thinking about? Do we need to buy more property in 2021? Are we going to be able to do it if we just buy one property? So those are things that we can help you think about. But that's what we're coming back to, though, is those 7 material participation tests. How do we get everybody in the partnership group to hit one of those 7 tests?
So I guess the best way the next step would be to, like, get with the team and discuss it out. And I'm already signed up with you, so that shouldn't be a problem. And I think maybe Jyoti could sign up with you guys too, and that way it will be easier to communicate and set things up properly to start with, I think, on the onset.
Yeah. And when you reach out to our team to have that conversation, CC me on the email just so that I am able to brief my team on what we're trying to do here.
That's perfect. Cool.
Thanks,
Brandon.
No problem.
James had a question in the chat.
Oh yeah, James, is it possible do you want to come off mute and ask?
Yeah, that'd be great.
Yeah, do it.
We have a number of rental properties. They've all been on Schedule E. They're long-term rentals. We do have a business office in the home that we use. Never taken the tax deduction. Is there any way to ever set that up where that would be possible?
Yeah. Yeah, absolutely. Yeah. Look, so there are rules around home office deductions, and I don't know all of them off the top of my head. You've got to use it regularly, continuously, and exclusively for the business. And there's some other steps in there. So refresh on that first. But at a more macro level, can I take a home office deduction with rental real estate? Yeah. If you meet the home office rules and you have a legitimate deduction, then yes, you can claim it against your rental real estate as long as your rental real estate rises to the level of a trade or business. Most rental real estate does. Yeah, most rental real estate does. Now, if I'm investing in a syndication as a passive investor, that's where it's not rising to the level of a trade or business. That's not going to be home office eligible. But if I've got my own rentals, I'm probably good to go.
How do you tie it between the Schedule E versus the Schedule C home office deduction unless you set up like a management company or something to handle it? Is that what you have to do?
Yeah, well, you can do it with professional software because we can point it to whatever schedule. Like we can point it to Schedule C or to Schedule E. Are you using? Do you have a CPA or are you DIYing it?
Just doing it ourselves. Yeah.
DIY. My understanding is that like a TurboTax or H&R Block, it only allows you to route it to Schedule C. So I don't know how you.
Okay, so we just have to get somebody to do that.
Yeah. Basically, you would want that home office deduction to show up on Schedule E. The only caveat is if you, like I think I was working with somebody on this recently, and they were having the same issue with TurboTax. The home office form, it's like 88 something or something. But the home office form, when you fill it out, it points to Schedule C, and that was the only option in TurboTax. So what I had him do instead, and I don't know if this is technically correct, but I had him just throw it on line 19 on Schedule E in a statement, and then attach the home office form to it. So he basically hard codes the deduction. The only thing though is that you just have to be careful because a home office deduction cannot make you go negative.
Right.
It can't add to a negative. So that's the only, if you're already negative, then you're just documenting the home office deduction that's being forward.
We're positive, so
cool. So you won't have that issue.
Okay. All right. Thank you, Brandon.
No problem.
James, there's actually a really handy auditor's guide on a home office deduction on the IRS website if you want to walk through, like, whether you qualify for it. The only other thing I would say too is when you do go to sell the primary residence, even if you get a Section 121 exclusion, you still have to pay the percentage taken as a home office deduction as depreciation recapture. Correct me if I'm wrong, Brandon.
No, you're 100% right. 100% right.
So because even if Because I'll have, people that get the full amount of the gain excluded under 121, but they depreciated their home office for a business activity. Well, they still have to pick up that as ordinary income.
Yep.
Appreciate it, recap.
Right, yeah, anytime you got to recapture that. Thank you,
Yeah.
thank you.
No problem. Lana, you had a question.
Since we're talking about single family rentals, let's say a married couple in the state of Texas, community property, owns single family home as a rental. One spouse dies. Does the surviving spouse get a step up in basis at that point?
Mm-hmm.
Fantastic. Okay, so technically, does that mean that on the books, the property value goes up to the market value? All depreciation up to that point is forgotten, and then we start depreciating the property at the market value as of today on the 27.5 straight line going forward? Or
Okay,
not?
so Texas is community property. Actually, my answer might be a little different. In general, when one spouse, my answer might be a little bit different. But anyway, in general, when one spouse passes away, spouses are typically 50-50 on the properties. So I've got half my basis. My wife has the other half of the basis. If she passes away, then I get her share of the basis stepped up. So not the entire property doesn't step up, but her share of the basis would step up, and then I would get to report that.
Are you absolutely sure? Because Texas assumes one dies, the whole thing. Because I've talked.
Well,
to,
that's why with community property states, I'm not 100% sure.
yeah, because it is a community property state.
Yeah.
Okay, well, let's say even it's 50. So you're saying that 50 that gets to step up goes through that what I've just described, taking as of today market value, forget about all the depreciation that happened up to that point, and just going forward, just as if you buy a new brand new property, basically.
Yes.
Market, correct?
Yes.
Okay, follow up. That's fantastic. That's awesome. Not that I want anyone to die, but
Oh, jeez.
Sounds like some tax planning right there.
no. Actually, no. Follow up question: what if the death scenario happened 10 years ago, and the step up was not done as it should have been done? Okay, now, oops, we realized that was done not. The property, that surviving spouse still owns the property. So could the surviving spouse do something at this point retroactively? Because we're talking, at this point, we're talking about huge potential, taxes that you don't have to pay.
I would say, so I don't know 100%. My gut says probably, but I don't know procedurally what that would look like. I don't know procedurally I don't know what forms you'd have to file to get that done, or if you would just simply step it up on your next tax return. I think that would be something that would be worth exploring, though, with a tax advisor.
Okay.
If there's enough basis, then that could certainly be something worth exploring.
Okay. Thank you.
No problem. Great question. I'm actually going to go look up the community property basis
Yeah,
adjustment.
Me too.
That would be great, guys, because this is actually an actual real life question that could potentially save someone a lot of money, because step up was not done.
It was my understanding that in the community property states, the surviving spouse gets a full step up in basis. In common law states, they only get the other spouse's half. That was my understanding. There's 7 community property states, I think. That was my understanding, but I'm going to go look at the regs as well.
Well, if you beat me to it, go post in the TaxSmart Real Estate Investor Facebook group.
That's for most assets, like, brokerage accounts, that step up. And it's not just for the primary residence or the house or what have you. So it is very significant. Yeah, I would say.
Good to know. Yeah, I'm going to go look that up. It's a great question.
Thank you.
What other questions do we have?
Hey, Brandon, I've got one just talking about the home office deduction.
Sure.
If somebody sells their home and then they'd have to pay back the depreciation recapture for they've taken the home office deduction, say 10 years or so. If they're if they're in the 12% income tax bracket or the 0% long-term capital gains, how is that? How does that flow through with depreciation recapture? Does that make sense?
Yeah. So what you're asking is when you recapture depreciation on a home office, what is the tax rate? So what we're talking about here is unrecaptured Section 1250 gain. And unrecaptured Section 1250 gain is taxed at a maximum rate of 25%, but it scales up, and it scales up based on taxable income. So if you are in the 10% tax bracket, I'm actually not sure where the tax bracket, the capital gain tax brackets fall related to the marginal tax brackets off the top of my head, but let's say that you're in, let's say putting you in the 10% tax bracket actually puts you into the 0% capital gain tax bracket, then your Section 1250 recapture would be 0%. If you're earning enough taxable income where it kicks you into the 15% capital gain tax bracket, then your Section 1250 recapture is 15%, and so on and so forth up until you hit 25%. Does that make sense?
Great, thanks.
That work? Good question.
Maybe it's just me, but I'd love to have, like you're saying, your longer podcast series on depreciation and depreciation recapture and the things that affect it.
Yeah, I'll make a note of that. Cool. Does anybody else have questions?
I'll jump in with another just very quick one. If I'm transferring title for a single family rental from under my personal name to newly single member LLC, there are no tax implications, right? I could just do it, not worry about anything in terms of taxes.
Yes. So when you are transferring property into or out of an LLC, whether it's a single member LLC or a partnership, no tax implications, at least no tax liability implications. You do have to be careful if you're transferring into or out of a partnership. There's always basis calculations that you're gonna have to run. And if it's ever gonna be taxed as a corporation, like if the entity ever ends up being taxed as a corporation, that's where we see some issues. Like somebody will, you know, we run into issues every once in a while where somebody's flipping a property and it's in an LLC, and then they sell the flip, or sorry, they flip it, and then they say, well, I actually want to move it into my rental LLC and hold on to it. So they move it out of the LLC, move it into the rental LLC, but then all the other flips in that LLC that they moved it out of, maybe they're netting $100,000. So we look at it and we go, well, hey, we want to be an S corporation to mitigate FICA taxes, reduce our exposure there. FICA taxes are self-employment taxes. And it becomes an issue when they've moved a rental, or they've moved property out of the LLC, because we can't retroactively tax that company now as an S corporation, because moving anything out of an S corporation is a taxable event. So even though they held onto the property, taxable event. That's where we come up with the issues. But as long as it's an LLC, single member partnership, you can move into and out of all day long.
Even if it's, say, 2 layers. So Texas LLC holds the property, and then Wyoming LLC holds Texas LLC, but everything is single member disregarded. So it's all good.
All good. All good. Another potential issue, just so that you can like file it away. If you ever do this in the future with like partnerships, you move property in, and then a partner in the partnership like leaves the partnership, then you might be tripping some disguised sale rules. So always be careful about like unique structuring opportunities. A lot of times, if it sounds too good to be true, it's probably too good to be true.
Okay.
Great question.
Reminds me of a tax court case. I can't remember, but it was a sale leaseback where the parents had sold the property to recognize a loss to the son, but then leased it right back. So the IRS came calling back and said, hey, you know, there's substance over form, right? I mean, you sold the property at a loss to book a loss, even though you still acquired it, because substance over form, you leased it right back from the son. Yeah, it was like related party transaction even too, and I'm trying to think of the name of that case.
Yeah, 100%. You just gotta be careful. There's a lot of people that make a lot of money selling tax structures, and
I've been seeing that a lot.
strategies.
A lot. Like I'm just like,
Yeah.
And like a lot of the other real estate investing groups, like the Burr Method group, and just yeah, you got to be really careful with that.
Yeah.
Actually, to follow up on that, since you guys keep talking on the same issue, Thank you, Ryan. I just thought of something very related. So tell me if what I'm thinking is wrong. I have a rental with very low base basically, which I'm going to gift to my parents potentially. Okay. I'll fill out whatever form needed, so it's all good. So they have and they will live in it as their homestead. So they have this $500,000 exclusion, which is great. Who knows what life holds? They might sell it at some point, or they might live there forever until the end of days, right? What I'm thinking about doing, since it's everything in the family, I'm thinking that and this is where my question is, what if once they get the title gifted from me, they would simultaneously sign, I don't remember, Lady Bird deed, I believe it called, that says basically in case of my death, the title goes to such and such person. So they would sign the deed saying in case of death of both of them, the title goes back to me. And is that potentially going to raise an issue?
I believe so. I believe there are rules around that. And I want to say that there's timing requirements. I don't know off the top of my head, but something like, as you were talking, I was sitting here going, that would be something that would require some research and planning up front to make sure that whatever rules exist around gifting and then inheriting it back if my parents die, I want to make sure that I'm really clear on how that's going to affect basis, because that would be one of those things that sounds too good to be true, and it might work. I just don't know what those rules are off the top of my head.
My first question is, I can't remember in section 121, which is the $500,000 exclusion that you're mentioning, is if they step into the shoes of your basis, or do they have to live in the property for 2 years in order to sell it and exclude it? Because what the IRS would come and say is, hey, you got this property, it's appreciated tenfold, and you're gonna gift it, let them get the exclusion, and then somehow, some way they give it back to you, right? That's what I could see the potential be wrong.
Well, section 121, you do have ownership and use requirements, so you do have to use it for 2 years.
Which is fine. I mean, the idea is actually, it's all legal. It's not a scam. It's actually their home. They're going to live there.
No, of course.
Yeah.
So way over 2 years, hopefully. So it's all good there. My question is at the end.
Yeah, I don't know off the top of my head. You're asking really good questions. I don't know off the top of my head, but typically, there's when people try to get creative to eliminate tax liability, it's been done before, and there's rules around it. So, and I don't know what those rules are off the top of my head as it pertains to that specific situation, but that would definitely be something that if you were going to do that, you should get counsel or CPA to take a pretty deep look at that for you.
Okay.
Yep.
Thank you.
No problem. Jordan, you just came off mute. You want to ask a question?
Yeah.
Go for it.
How long are we going here?
I've got a few more minutes.
Okay. The main thing is around, well, I got multiple questions, but we can save it for another time. But back to the reps deal. So I have a service business. I've had it for 11 years, landscape industry. I've set up the systems. I set up the managers in place where they're basically running all of it. We collect the mail, we make some deposits, but we have a general manager in place that's making all decisions. We set up last year with an attorney, wrote up a bonus program for our general manager, operations manager, that if me and my wife spend less than 5 hours a week running the bit, or being in the business, then they would get this bonus. Didn't necessarily work out that well because of COVID and all that stuff, but we still didn't participate in the business more than 5 hours a week. Instead, we developed some commercial property, spent the majority of the time developing commercial property, as the general contractor, as the person making all the decisions, running all the budgets, all that fun stuff. Would you think that would qualify for rep status, even though I still took a distribution from the S Corp landscape business and I still paid us salary, W-2 salary?
Well, so how you get paid and to what extent does not qualify you or disqualify you for real estate professional status. So you could be paid from 10 different companies, and for real estate professional status, it's not going to matter. It might get you audited, right? Like if I've got a W-2 and I'm claiming real estate professional status, I might be audited. So I've got to have my documentation nicely laid out so that I can defend myself, but it's not going to negatively impact my ability to claim real estate professional if I can otherwise claim it. So to qualify as a real estate professional, 750 hours in a real property trade or business or businesses, and more than half my time in real property trades or businesses. The question is, what real property trades or businesses am I materially participating in? Because again, 750 hours and more time in real property trades or businesses that I materially participate. Now, I could be a developer for 300 hours. And if my development activities rise to the level of a trade or business, then it's a real property trade or business. I'm good to go. So whatever development activities you're doing could count. Maybe I only get 300 hours there. So maybe I'm also going to be a real estate broker for 300 hours. And then maybe I'm a landlord for 200 hours. So my total time in all real property trades or businesses is 800 hours. I qualify as a real estate professional because I've hit that 750 and maybe I don't do anything else. That's all I do. Then the next question is, did I materially participate in my rental activities? If you have property managers on them, it's going to be difficult to substantiate. You said you had property managers on them, right?
I have and that's another part of the question is I have a property manager on one of our properties, but the rest of our properties are self-managed.
Okay. Yeah. So if you're self-managing your properties, here's a cool strategy. If you're self-managing your properties and then you add a couple more and you put property managers on them, as long as you hit the 500-hour material participation test on your own self-managed properties, then you can make the elections under Treasury Regs 1469-9. You can make the election to aggregate all rental activities into one. And so since I've already hit the 500-hour test on the properties that I self-manage, when I pull in these other properties that are managed by property managers, or when I pull in syndication investments, what I'm doing now is I'm looking at the entire group as one activity that I already materially participate in. So now everything's non-passive. So you can plan around that material participation rule, especially if you are self-managing, you're not scared of self-managing.
Great, thank you.
No problem. Sandy and Mike, you guys just joined. Do either one of you have questions that you would like answers to real quick?
Actually, no. He
Okay.
just kind of touched on the question I had. So
Cool. Two birds, one stone. Love it. All right. Going once. Any other questions? Going twice. Cool. Thank you very much for joining. This has been recorded. I will be posting it on YouTube. I'll clean it up a little bit and probably like edit out the long pauses. But thank you very much for joining our first one. I don't know how often we're going to do this. My goal is to do it weekly at some point once we build up enough like momentum and people are jumping in. This is a really good first one. I loved it. So thank you for coming. Appreciate the tough questions. You guys are keeping me on my toes. That was awesome. And I will see you in the Facebook group.
Thanks, Brandon, for your time.
Thank you.
Thanks, guys.
Thank you.